Hello everyone, we are Group 9. Our topic is the impact of the Fed's interest rate hike on Indonesia foreign debt. First, the reason for the rate hikes. After the pandemic, high consumer demand, broken supply chain, and rising energy prices pushed U.S. inflation way over the 2% target, so the Fed raised rates many times, from near zero to about 5%. Higher rates make borrowing more expensive, slow down spending and investment, and this is to bring inflation back under control. But this rate hike affects the whole world. U.S. rates up mean the dollar gets stronger and harder to access globally. Investors move their money to the U.S. for better returns. So capital flows out of other countries, mostly emerging markets. This makes borrowing more costly for those countries, especially ones with dollar debate. For emerging markets, the stronger dollar is a big challenge. They have to pay more to repay dollar loans. Their local currencies fall in value, and the imports get more expensive, which pushes up their inflation. Even if their exports become cheaper and more competitive, the bad effect, tighter financing, higher debate costs, and weaker currencies usually weigh on their economics. In short, the Fed's rate hike aim to fix U.S. inflation, but their effects spread far and wide. It shows how connected the world's economics are today.
Okay, next I will focus on the structure and current situation of Indonesia's external debt, reviewing its true resilience in the face of external shocks, especially when the Federal Reserve raises interest rates. Firstly, from a macro-prudential perspective, the fundamental of Indonesia's external debt exhibit complex characteristic of controllable total amount, structural differentiation, but prominent monetary pressure. Although Indonesia's total external debt has remained a high level in response to the post-pandemic economic recovery and infrastructure construction needs, its external debt to GDP ratio has been carefully controlled with a health range of around 30%, far below the internationally recognized 30-60% warning line. Meanwhile, the debt repayment ratio is also within the controllable range, providing a solid defense line for Indonesia's economic solvency. Going deeper into the structural level, we will discover more details. In terms of departmental structure, the promotion of external debt between the public and private sector is relatively balanced. Government debt mostly comes from long-term preferential loans or sovereign bonds from multilateral institutions with stable funding source. Private sector debt, on the other hand, is more concentrated in finance and manufacturing and is more sensitive to market liquidity. In terms of maturity structure, long-term debt continues to amount for over 85% of total debt. This solid amount greatly elevates the short-term concentrated repayment and refinancing risks that may arise during the Federal Reserve interest rate-like cycle. However, beneath the overall positivity lies a core vulnerability, namely the so-called original sin issue. The composition of currency, the proportion of Indonesia foreign debt denominated in US dollars is extremely high, usually exceeding 70%. So this serious currency mismatch makes Indonesia balance sheet highly sensitive to fluctuation in the US dollar exchange rate. What does this mean? That means that the once Federal Reserve raised interest rate and caused significant appreciation of US dollar, even if Indonesia companies do not borrow a penny more, their debit burden denominated in their local currency will passively inflate due to the valuation effect. This will directly squeeze corporate profit and consume the country's foreign exchange reserves. In summary, Indonesia external debit management has built a good buffer in terms of total volume and maturity structure, but its highly dollarized debit composition make exchange rate risk the most vigilant Achilles heel when facing external monetary.
In this part, I will explain transmission phase 1, which is the exchange rate channel, how US monetary tightening can affect Indonesia through rupiah depreciation, higher IDR debit burden, and potentially imported inflation. First, why would the rupiah weaken when the FED tightens? When US interest rate rise, USD assets become more attractive. Under an interest rate parity framework with risk premium, investors may rebalance portfolios away from emerging markets towards the US dollar, especially when global risk appetite falls. For Indonesia, that means capital outflows and upward pressure on IDR per US dollar. In other words, a weaker rupiah. Second, the weaker rupiah creates a mechanical revaluation effect on USD. Denominated external debit. If foreign debit is D in USD and the exchange rate is E in IDR per USD, then the rupiah value is E multiplied D. So if E rises, the debit burden in IDR rises 1 for 1, even if the USD debit stock does not change. Using World Bank annual data as an illustration, Indonesia's external debit was about 417 billion in 2021, and the average exchange rate moved from 40,000 to 14,850 IDR per USD in 2022. Holding the USD debit fixed at 2021 level, that depreciation alone would increase the rupiah value of debit by roughly IDR 223 trillion. Third, depreciation can contribute to imported inflation because many imports like fuel, food, and intermediate goods are priced in USD. If the rupiah weakens, these imports become more expensive and can pass through into CPI. That creates a policy trade-off for Bank Indonesia. Tightening may help stabilize the currency and inflation, but it can also slow domestic demand. That's the exchange rate transmission.
Alright, hello everyone, my name is Maza and my part is to explain how the US interest rate in hikes affected to the capital flows and the financial market in the Indonesia. So higher US interest rate has increased the returns on dollar assets and widened the interest rate gap with emerging market. As a result, the global investors shifted funds back to the United States and leading to the capital outflows from Indonesia, so especially from bonds and equities. And this has reduced the foreign demand for the Indonesian financial assets. And in the bond market, the foreign selling caused the bond price to fall down and the yields to rise, and which has tightened the financial conditions. So to stabilize the rupiah and maintain the confidence, Bank Indonesia raised the domestic interest rate, but this also increased the borrowing cost for the economy. And financial market volatility became more noticeable, and Indonesia experienced large foreign bond outflows, including about the USD 4.6 billion in September 2025, while the equity market faced the weaker investor sentiment. So these conditions has increased the pressure on the private sectors. Although the Indonesia's external debt is around USD 424 billion, but or is about the 30% of GDP. The higher interest rate made the refinancing more difficult, and companies has with foreign currency debit faced higher repayment cost and also some delayed investment plans. So in the end, the U.S. monetary tightening led to the capital outflows, higher domestic interest rate, and increased the market volatilities. So which has raised the financing risks and added the pressure to Indonesia's financial stability. Yeah, that's all. Thank you.
I'd like to share with you some key insights from our analysis of the Bank of Indonesia's recent policy responses to global financial tightening and external shocks. As the Federal Reserve aggressively raised interest rate, Indonesia, like many emerging markets, faced significant capital outflows, currency pressure, and inflation risk. In response, the Bank of Indonesia adopted a multi-pronged strategy, raising interest rates faster than expected to occur and inflation and attract the capital, actively intervening in foreign exchange markets to smooth volatility, and easing macroprudential policies to support credit growth, a tight money loose credit approach. The results have been mixed but largely positive. Inflation has fallen steadily towards the target range, and financial stability has been maintained. However, exchange rate stability has only been partially achieved, with intervention coming at the cost of depleting reserves. Economic growth has also slowed, highlighting the trade-off between stability and expansion. Looking ahead, Indonesia's policy focus must shift from crisis response to resilient building. This means relying less on costly FX intervention and more on interest rate and clear communication, strengthening structural reforms to attract long-term investment, and deepening financial markets to better withstand future global shocks. In conclusion, Indonesia's experience shows that while central banks in small, open economies can effectively defend against internal instability, their ability to fully offset global forces is limited. The journey ahead requires flexibility, foresight, and a continued commitment for strengthening economic fundamentals.